Hello, everyone. My name is Sam Stovall. I'm the Chief Investment Strategist with CFRA, and I would like to welcome you to today's webinar, Is It Time to Buy or Bail? CFRA's review of 2018 and our outlook for 2019. During today's session, we will hear not only from me, but also from my colleagues, Lindsay Bell and Todd Rosenbluth, as we provide our latest market outlook, just ahead of the first quarter earnings announcements. Before we get started, I wanted to remind you that today's session is being recorded and a link to the recording will be made available within the next few business days. During today's session, you may submit questions using the GoToWebinar questions panel, and we will do our very best to answer as many as we can. So before I would like to dive in, let me introduce my esteemed colleagues. First is Lindsay Bell, who is an investment strategist for CFRA and is well known for her market observations and sector opinions that are expressed in her Sector Intellect articles on CFRA's MarketScope Advisor platform. Lindsay works with the CFRA team to determine appropriate asset class allocation and equity sector level weightings, and she participates in projecting the firm's 12-month S&P 500 price target. Next, we have Todd Rosenbluth, who is Senior Director of ETF and Mutual Fund Research at CFRA, where he leads the firm's holdings-based research efforts within the Equity Research and Funds Group. Todd publishes regular thought leadership content on equity and fixed income products, maintains the quantitative fund models, and is a member of CFRA's Portfolio Strategy Committee and the Investment Policy Committee. Before we get started, what I'd like to do then is to give you an idea of what our agenda is going to be. I'm going to tell you a little bit about CFRA, who are we, and how we add value. Then I'm going to be discussing a market outlook. Is it time to buy or bail? Next, Lindsay will talk about the sector outlooks, in particular earnings trajectory and whether it is going to be slowing and by what amount. Finally, Todd will talk about CFRA's views on ETFs shifting course. Then we're going to open it up for questions and answers and then let you know about the next seminar, webinar that will be scheduled for the next couple of months. First off, I'd like to take the opportunity to explain the history of CFRA. We've had more than 90 years of innovation and growth as an independent research firm. Now, you might think from the slide that you're looking at now, gee, how do we have 90 years of experience when CFRA was founded in 1994? Well, it's because in October of 2016, CFRA acquired Standard & Poor's Equity and Fund Research. This department extends back to 1927 when S&P Global Equity Research coverage first began. Today, CFRA is one of the world's largest independent research firms. Our clients are found across a spectrum of investment firms around the globe. CFRA is trusted by the most sophisticated global firms ranging from asset managers to hedge funds and mutual funds, all the way to pension funds, wealth managers, and online brokers. We also offer research to private companies, accounting firms, academics, as well as libraries, both in the academic, insurance, and law firm area. Our services are used to support multiple investment strategies, including long-short, diversified portfolios, and risk management and alpha preservation. If we selected one word to describe CFRA, it would be independence. Since research is all we do, CFRA does not manage money or make trades, even though many investment research providers out there on the street today claim to be free of conflicts. They are not. Finally, our equity research service delivers independent research and commentary that helps wealth managers and investment advisors better manage their clients' financial lives. We cover on a quantitative basis more than 11,000 stocks, on a qualitative or analyst-driven basis more than 1,500 companies, that are found in 11 sectors, 68 industries, and we also offer research on more than 1,800 ETFs and 22,000 mutual funds. So with that, you now have a pretty good idea of who we are, how long we've been around, and how we add value. Now it's my turn to talk a little bit about adding value by telling you whether I think it's time for investors to buy or bail. First off, I think we have to describe what's been going on and what is likely to occur in the year ahead. I think 2019 is going to be experiencing tougher year-over-year comparisons, whether you look to economic growth or whether you look to earnings growth, primarily because the bar was set so high in 2018. In particular, earnings were expected to be up about 11.4% at the beginning of 2018. Now it appears as if we're going to be up close to twice that amount. So with tougher comparisons, with a rising interest rate environment, with the extension of this economic expansion, etc., our belief is that U.S. share price appreciation will approximate that for EPS growth this year. We advise investors to focus on high quality issues, but also think because the Fed is approaching the end of its rate tightening cycle, we should see lessening pressure on bonds, but at the same time, we do not see a recession on the investment horizon. Volatility is something that investors have been experiencing over the last year. We were lulled to sleep, in my opinion, in 2017 when the S&P 500 recorded only 8 days in which it was up or down by 1% or more. In 2018, we had 8 times that number. So we ended up moving above the average of 51 going back to 1950, but at 64, we were still below the average of 70 since 2000. So yes, volatility has come back and come back with a vengeance. We also are facing some historical headwinds. Should the Fed end its rate tightening cycle this year, history tells us that yes, we could still see a positive return. However, expect below average terms because they were the norm in post-tightening cycles. Second, Republican president combined with a split Congress historically has delivered the weakest average annual price increase since World War II. And then finally, the S&P 500's rolling 10-year compound annual growth rate is now more than 1 standard deviation above the mean since 1918. Or in other words, we're getting a bit long in the tooth, and while it does not imply that we are ready to fall off a cliff, it does say that longer-term performances are likely to slow. As a result, from the peak on September 20th of 2018 through Christmas Eve, the S&P 500 declined at 19.8% on a closing basis, just missing being labeled a new bear market. However, mid-cap and small-cap stocks declined more than 23 and 26% respectively. They indeed did fall into new bear markets. Also, each sector within the S&P 500 posted a decline anywhere from as little as 2.8% for utilities to as much as more than 29% for energy. The reasons for this, I think, were multiple. First off, trade tensions, the worry that these trade tensions could morph into a global economic recession. Bull markets don't die of old age, they die of fright. And what they're most afraid of is recession. And I think of all of the rocks, if you will, in this wall of worry, the keystone is the trade tensions and whether that could throw the U.S. and the world into an economic slowdown and possibly recession. As a result of this, we would probably see an earnings peak, mainly because earnings have been so strong in 2018. And while every quarter in 2019 is expected to post a record level of earnings, the rate of growth is expected to slow. As I mentioned, political gridlock is a concern. And then lastly, the question as to whether the Fed has finished raising rates. Indeed, going back to the third quarter of 2018, every sector within the S&P 500 has seen a reduction in its 2019 earnings estimates. The S&P 500, which is circled on the screen, was expected to show a 10% gain in 2019. Now the estimate is for only about a 6% advance. Lindsay Bell will go into greater detail on earnings expectations for the market as well as for the sectors in particular. But this is not a surprise that we do end up seeing at least a economic recession whenever we have had an earnings recession. Indeed, of the last 15 times that we have had an earnings recession, it is translated to an economic recession about 12 times. So more times than not, an earnings shortfall does end up triggering a recession, but not all of the time, as you can see from this chart. It's also not a very good market timing tool. So while it does indicate that we should be a little bit concerned and watchful, it does not guarantee that we are headed for recession. Congressional gridlock, however, is a concern, but again, what it implies is a slowdown in price appreciation, not necessarily a new bear market. Looking back to 1946, what I did was I broke all political scenarios into either a unified government where the president and both houses of Congress were from the same party, a unified Congress but a different president, and then lastly, split Congress, where in this current situation, a Republican president with a split Congress. That has happened 8 times since World War II. The average price gain per year was only 3.5%, the worst performance on average, and certainly well below the average of 8.8% for all political scenarios since World War II. Also, as I mentioned, on a rolling 10-year compound growth basis, the price of the S&P 500 peaked recently in November with a gain of 11.9%. That's more than 1 standard deviation above the mean. And once we start getting rid of the depressing effects of 2008, 2009, then this rolling 10-year CAGR will look even better, rivaling 2019-29. Doesn't guarantee, however, that we are headed for a bear market imminently, but it does imply that we have to be realistic about our growth expectations going forward. Also, one of the concerns that investors have is that the yield curve is very narrow and possibly going to be inverting in the near future. An inverted yield curve simply says that the short duration fixed income yields more than the longer duration fixed income. From a business perspective, that ends up reducing loans that banks are willing to make to companies and therefore helps to slow down economic growth. However, we're not in an inverted yield curve scenario just yet, and I'm also encouraged by the fact that before every recession since 1960, the 10-year to 2-year curve has been inverted by an average of 11 months. So we are not in an inverted yield curve yet, and obviously, therefore, we've had no number of months to look back to see inversion. So that leads me to believe that we have a ways to go before this economy slips into recession. I'm also encouraged when I remind investors that, you know what, market declines of 5% or more are fairly commonplace. It's not something we should be assuming is brand new and we don't know how to react to it. Indeed, pullbacks, we've had 56 of them since World War II, and these are declines anywhere from 5% to just below 10%, have occurred about once every 9 months. Corrections, which are declines of 10% to almost 19%, occur essentially every 2 years. Bear markets have lasted around every 5 years. So again, a reminder that, yeah, corrections and pullbacks, and we've had 22 corrections since World War II, are pretty normal occurrences. Another thing that makes me feel pretty confident that we have likely seen the bottom of this most recent correction is that the PE on forward 12-month earnings, according to S&P Capital IQ consensus estimates, hit a level close to 14 times on December 24th, which rivaled the average of 13.7 for all pullback and correction lows since this bull market got started in 2009. So let me repeat that the PE of about 14 times seen on December 24th rivaled the average of 13.7 that we saw at prior correction and pullback bottoms since this bull market got started. One more factor that is encouraging for me is that when you look at a rolling 52-week relative strength between the S&P 500 price change and the next 12-month earnings estimate, what we find is that we have bounced midway between 1 and 2 standard deviations below the mean, a level not seen since October of 2008. So with that, I still think that there is upside potential for 2019. CFRA's Investment Policy Committee has a year-end target of 29.75, which actually is in line with the rule of 20, which looks at PEs and inflation and gives you an idea of where the market's fair value is. According to Action Economics, their estimate for the year-on-year change in core CPI could approximate 2.5% by the end of this year. And with S&P Capital IQ consensus estimates at about $170 per share for the end of 2019, that gives us a fair value close to $29.75, or a number nicely higher than where we are today. So with that, I will now pass it on to Lindsay Bell, who will dive a little bit deeper into the earnings estimates for 2019. Lindsay?
Thank you, Sam. I will go ahead and get right into it with my first slide here. I like to take a look at where we've been and where we're going with regards to earnings growth. This is a quarterly representation of that earnings growth picture. And you'll notice that we're over 2 years out from the last earnings recession that we saw in late 2015 and into 2016 that was really driven by a sharp decline in energy prices. What you'll also see, too, is that on the right-hand side of the chart, after we've finished 3 quarters of more than 20% earnings growth in the S&P 500, something that we haven't seen since 2010 and 11 when we were emerging from the Great Recession, you will see that the out numbers have come down pretty substantially since the start of the fourth quarter on October 1st. That's the orange bar. That's where we started at. The blue bars are the current estimates for the fourth quarter of 2018 and the next 3 quarters into 2019, or actual results for the historical numbers. I'm going to focus in my presentation largely on the fourth quarter, since we're going to kick off earnings season really next week. We got a couple of reports out today, and they've been trickling in over the last couple weeks, but we'll get into the thick of it in the next couple weeks. Currently, the estimate for fourth quarter earnings growth is 12.8%. That's a pretty substantial decline, about 560 basis points from the 18.4 expected on October 1st. This is the first quarter, by the way, this year where we've seen earnings estimates move lower, which is the historical normal trajectory for earnings. Estimates come down going into the reporting period, although in the last 3 quarters, given tax reform, fiscal stimulus, and deregulation, as well as buybacks, you've seen estimates move higher going into the reporting period for the prior 3 quarters. So really what this chart shows you is that growth will be decelerating as we move into 2019. That's something that the market has grappled with over the last couple months, and I'm going to try to explain what exactly is happening. It is important to note we will be going from over 22% growth in 2018 on an earnings basis, full-year earnings basis, to 6.1% in 2019. Those numbers have come down for 2019, like I said, over the last couple months, with the sharpest reductions in December and late November. Turning to the next slide, let's dig really into the fourth quarter estimates. This shows how that 12.8% is broken down by sector. You'll see energy once again leading with almost 68% earnings growth on a year-over-year basis. That is, that sector is still recovering from that 2-year or, 1-year earnings recession. Actually, for the energy sector, it was 2 years. For the S&P 500, it was 1 year of earnings recession. So that number looks pretty inflated still as they pull themselves out of that recession. Then you've got some financials, industrials, communication services. So you kind of have some of these cyclical sectors continuing to lead. Once again, this quarter, the one that has moved down the line over to the left with a lower level of growth, and I'll get into this later, is technology, looking at 10% growth. That has been a leader in the earnings growth space for really the last couple years. So you're starting to see estimates there move down. Overall, it looks like it's going to be a really good quarter. In general, you only have two sectors, utilities and consumer staples, that are projecting declines in earnings growth rates. Staples is really a competition issue. Inflation was an issue earlier in this year. That's kind of cooled off, and utility is a highly regulated business, tied to the weather. This morning, I just want to make a note of one of the companies that reported, Constellation Brands. It was a really good quarter, and I think that Constellation Brands can really be kind of an example of what we might see throughout the earnings period. So they had a great quarter. They beat top and bottom lines, but their outlook for 2019 was pretty weak, below consensus estimates. They projected $9.20 to $9.30 in EPS for the full year of 2019. That's 19% below where consensus was. Part of that was because the interest expense related to their Canopy Growth acquisition, which is the marijuana company. They invested $4 billion into it, and they used debt to make that investment. They noted that's about a 25% hit. The stock was down double digits early this morning. But also they're starting to see a slowdown in their wine and spirits business. So I think you're going to see companies that have been acquisitive could potentially be punished in the reporting period. We've seen this from a couple others too, given higher interest rates. But also, we're going to keep a close eye for slowdowns in any businesses that are occurring. Turning to the next slide, though, looking at the trends for what happens for earnings growth for the S&P 500 overall. The S&P 500, even if numbers are coming down, like I said, that's typically the normal trend. You usually see results come in better than expectations at the season start. The S&P 500 has beat earning estimates since the first quarter of 2009, every single quarter. So that goes back quite a while. This chart here, on the left-hand side, it lists the quarters, and then the first column of numbers is the beginning of the quarter. So for the third quarter, it would be July 1st. Then you see the growth estimate at the season start, which is usually when JPMorgan reports, or when earnings season really gets underway, that we kind of lock in that growth rate. And then the last column of percentage rates is the final or actual result of what occurred. And then the final column, you see the difference between that final or actual number versus the season start, and you see in the quarter shown here, the beat rate in basis points there. The last three quarters really were outsized. 743 basis point beat in the third quarter, 566 basis point beat in the second quarter, over 700 in the first quarter. That really pushed up the average beat rate on a 5-year and 10-year basis. As you see at the bottom of the chart here in bold face type, the 5-year average is about 440 basis point beat. The 10-year average, 400 basis point beat. So I put that in a range of on average, you expect the S&P 500 growth rate to come in 400 to 450 basis points, or 4 percentage points to 4.5 percentage points better than initial expectations. Before the last three quarters, that rate was, I would always tell people that you could see growth better by 3.5 percentage points to 4 percentage points. So that has moved up in the last 3 quarters. If we get, say, a 4 percentage point beat rate, you can get, 17.5% growth this quarter, which again, really, really good numbers. But the problem is that growth trajectory. Digging into sales, this is an important component of the fourth quarter, 6.2% growth. That's really solid by a historical perspective. On average, since the fourth quarter of 2009, quarterly sales growth has been about 4.4% growth. So 6.2, well above that, though it is a deceleration from the 9.5% average growth that we've seen in the past 4 quarters, again, driven by stimulus. Taken all together, full year 2018 sales growth is expected to be 8.7%, again, the best since 2011. But going forward to 2019, we expect to see a reduction to 6.8%. Now, notably, the 6.2%, like I said, better than the historical average. But while the earnings per share numbers have come down over the last, over the course of the quarter, really, this number has remained pretty stable. On October 1st, expectations by the consensus were for growth of 6.4%. That actually increased to 7.1% on December 1st. And since then, it's been reduced. I think there is real concern about, again, a slowdown in growth in general. So numbers have come down a little bit. When you're looking at sales numbers, you always have to consider where the dollar is, given almost 50% of revenue for the S&P 500 comes from overseas. The dollar, on average, the DXY is what I look at. The DXY index is up 3% in the quarter on average, in the fourth quarter on average. That's an increase from the 1.6 appreciation recorded on average in the third quarter, and a reduction in the dollar in the first half. So you'll probably see companies call out the dollar as an impediment to sales growth. But looking at the sectors here, again, same sectors lagging, staples and utilities, but at the head of the pack, again, energy, consumer discretionary, and healthcare. And we think those numbers are probably pretty safe. And this will be important to watch how sales evolves over the earnings period as guidance is provided, because sales is an important component to margins too. So the question is sales going to get hit, or is it going to be margins as increases in wages and things like that are impacted? Now, taking a look at valuation, I think this is an important slide to talk about, because when you think about 2019 and the concern for slowing growth, take a look at this chart. It goes back to the beginning of 2014, so a little over 4 years, really. You see a sharp drop off. We peaked at the end of January here with over 19 times on a PE basis in January of 2018. We took it all the way down in December to just about 14 times. Sam noted that on December 24th. May be a low for the PE. Maybe it was put in. Right now, the market's trading at about 15.1 times. That's still below the long-term average of 16.4 times. I know the 5-year average was 17.1 times for PE over the last 5 years. So it's still pretty steep discount. And then if you just look at the last 3 years, in 2018, the average PE, given all this volatility, was still 17 times, which was a reduction from the 18.3 times average in 2017 and the 17 times average in 2016. So we're getting back to 2016 levels here. Now the question is that 6.1% growth that is pegged for 2019, is that too high? Usually we see earnings growth estimates come down by about 5.5 percentage points from January 1 to the end of the year. So that would, pretty much assume flat earnings growth. If we do get flat earnings growth in 2019, based on where the market is now, that says that the market's valued at 15.9 times. So that's still a discount to the historical average, but if you're assuming growth is going to be a little bit slower, then you deserve a discounted multiple going forward. However, we don't believe 0% growth is really likely this year. You have oil prices beginning to stabilize and move higher. The dollar is expected to remain stable throughout the year. The Fed seems to be on a trajectory to pause interest rate increases. That's a huge component to where the market goes this year and where earnings go as well. We don't expect a recession. Sam got into some of those details. Trade, obviously, is the number one risk here. But if that gets resolved, which we believe it can get resolved, and President Trump and Xi both have every incentive to get it resolved, you could see earnings growth of anywhere from 2 to 4% for the full year. So that would be supportive of higher prices in the market going forward. That being said, we think that the earnings season could be a volatile one. We expect a lot of these companies to really cut guidance for 2019 going forward. Again, you saw that with Constellation Brands. FedEx came out, they reported earnings in December. They cut guidance. They mentioned a slowdown in global trade. They're reducing hiring, they're limiting hiring, they're asking for voluntary employee buyouts, so they're managing their costs. You saw, obviously, Apple was a big cut in earnings guidance last week, and that's a big deal because it's a big part of the tech space, which I'm going to get into. But you've seen big cuts across the board. These aren't just, a couple cents here and there. They're double-digit. That's double-digit earnings growth rates. So moving on to digging into just two sectors real quick before I pass it to Todd. I want to look at financial sector because they're going to kick off earnings season next week. Citi reports on Monday, JPMorgan and Wells Fargo on Tuesday. Then Bank of America, Goldman Sachs, PNC, U.S. Bancorp on Wednesday, more of the regionals at the end of the week. 24.2% growth. You see the orange bar here on the right. That's pretty spectacular, especially when you think you're just getting over 12% growth for the index, right? But this was the worst performing sector, the financials, since the beginning of December. Obviously, the Fed had something to do with it. It declined 10%. Both the banks are really important to this group. They account for 41% of the market cap of the group. And you've seen both the large cap and regional banks get beat up over the last month. Look, I think this quarter there are very low expectations. Sentiment for the banks is pretty low. The bright spot is, while loan growth is still low by historical standards, is expected to increase in the fourth quarter from third quarter levels, expected to be up 2.6%. Which sounds low, but people get excited about it when it's an acceleration quarter over quarter. Commercial and industrial loans expected to lead that. Trading might be a bright spot. M&A wasn't as strong. But really, when you think about the banks, they're trading based on what the expectations are for 2019. We're looking at 10% earnings growth for the financial sector in 2019. That number really has not moved. So from our perspective, there remains risk to this group as earnings season progresses. Loan growth is expected to still be slow next year. Interest rates have gone up, but they're expected, the rate of increase is expected to slow next year. That doesn't bode well for net interest margins or net interest income growth. The yield curve has been flattening. That's not really good for banks. It's hard for them to make money in that environment. A lot of people are forecasting M&A to slow throughout the year, so this will be something that we have to keep a close eye on. Insurance, notably, is only about 20% of the earnings growth here, or market cap of the sector, excuse me. So 8.5% growth, while decent. We've seen that number actually be reduced the most out of the three sub-industries within financials for the fourth quarter. A lot of that has to do with interest rates and some of the tragic events with hurricanes and such that we've seen. Finally, digging into technology, just a couple slides here. 10% growth, like I said, that's a sharp reduction. We've seen over 20% growth for the tech sector for the past 7 quarters, so almost 2 years. That just kind of puts it in perspective. It's 10% growth is at the bottom half of the S&P 500, 11 sectors for the fourth quarter. we think they'll beat. I'll get into that later. There's been a lot of negative news worked into this group too. So you're starting to see these stocks kind of turn around. Apple, like I mentioned, they cut their sales guidance and some of their earnings metrics operating metrics last week. So that's weighed on the sector. You've seen these technologies that Apple's within the technology, hardware, and equipment space. Apple, while 16% of the market cap of the tech sector, they represent 26% of earnings for the technology sector. So that's a big deal. Those numbers have come down quite significantly, but we've also gotten warnings from several other hardware companies like Samsung and LG. While they're not in the S&P 500, their cuts were pretty substantial, 18-19% from what was expected. Also, semiconductors, you saw a lot of the numbers there coming out before the Apple cutting their numbers on the back of significant declines in the memory pricing space. And the reason that growth has been able to, at 5.4% is pretty decent still for the semi space. Part of that has been related to, the final quarter of tax reform benefits, and then also some M&A activity that's been going on there. We think a lot of the cuts have been baked into this fourth quarter. This, however, will be another sector that you got to keep your eye on. It's all about 2019. Microsoft is the second largest company here, and that's in the software and services space. That's an area where we think you could see some positive surprises there. Microsoft is 18% of the market cap of this group. So Microsoft and Apple together are just under 40% of the market cap for tech. So those are the real key drivers here. Now, just on the final slide, I just wanted to show you the history of, while numbers for the tech sector have come down, more than average, what you usually see by the tech sector is more than a better than average beat rate. I talked about that, what is now 400 to 450 basis point beat for the S&P 500. Well, over the past 2 years, the tech sector has seen earnings growth beat by 800 basis points, so nearly double that. So we could see, by that measure, you might see 18% growth for the tech sector this quarter. But they are up against tougher comps. I talked about some of the structural issues within the hardware space, within the semiconductor space. But you have, again, I talked about some of the substantial cuts that you have seen. So, we would be surprised if you got a beat rate that was probably more in line with the S&P 500 for the tech sector this quarter. So maybe we get about 14% growth, which is still good if you look at the longer term history. But, the 32.5% growth in the third quarter might be the peak for technology in the near term. With that, I will pass it on to Todd to get into some ETF detail.
Thanks, Lindsay. Great to be here with everybody. I'm going to be talking about ETFs and the growing usage of them and where the money's going and why. So let's just jump in on the next slide here. We'll show you a pie chart of where the overall assets are collectively, over $3.4 trillion as of the end of 2018, and that's been driven by a really impressive 2018. A lot of the heavy lifting, as you can see here from the pie chart, was within fixed income. 31% of the net inflows went into fixed income ETFs. That's pretty impressive considering the Barclays aggregate index was flat for the year. I'd also say that U.S. equity and international equity saw strong demand considering the U.S. stock market was down and the international markets, both developed and emerging markets, were down considerably more in 2018. So money continued to move into ETFs as a go-to vehicle for both asset allocation purposes and tactical needs. And on the upcoming slides, and we'll start on the next one here, we'll talk about sectors. Since Lindsay talked a lot about the sector trends that are going on, let's talk about how we moved to a more defensive slant, what the industry did in 2018. So the blue is the first 3 quarters of the year of net inflows. It was led by growth-oriented sectors, specifically the information and technology sector. In the fourth quarter, we actually saw net outflows, not only for the tech sector, but overall for sector products despite the fact that defensive sectors like consumer staples and utilities, products like the XLP and XLI, which are two State Street products, the consumer staples Select Sector Spider, the utilities Select Sector Spider, both those track the S&P sectors. And so defensive sectors really were in favor in 2018, and the pace slowed. It was still positive for healthcare. Healthcare still continued to do well from a broader market perspective, but the growth obviously slowed. We saw on the next slide here a bigger shift in the smart beta space. So the term smart beta has been used a lot. I've used it as well on these webinars, basically as an alternative to market cap weighted. So as opposed to products that are tied to the S&P 500 or the Russell 1000 index or the MSCI EFA, if we're looking internationally, these are alternatively weighted based on fundamental or sentiment indicators that are out there. We lay out a number of those here, and you can see what really happened in the fourth quarter were defensive approaches, specifically dividends, lower volatility, and value really soared relative to how they had done the first 3 months of the year. And not surprisingly, given the slowdown that we saw in the broader market, demand for growth-oriented ETFs was really small. I want to touch on something Sam mentioned. Sam talked about quality and the benefits of quality. I don't have that in the slide here, but what we saw to kick off 2019 was demand for quality ETFs or higher quality ETFs. And QUAL, which is an iShares product, has actually the most inflows among all equity ETFs, and almost all of that money flowed in yesterday. So really impressive to see the demand for that based on the trends that we talked about. QUAL is a peer to SPHQ, which is an Invesco product. I'm going to get into depth a bit on one of the value side of it, but I want to just remind folks about the way that we do research at CFRA. As you may know, in addition to covering stocks, as Sam mentioned, we have research on both ETFs and mutual funds. We rate ETFs versus ETFs. We rate mutual funds versus mutual funds. Our approach is more forward-looking in nature than our peers that are out there, in part because we're looking inside the portfolio. We leverage the fundamental assessments and the valuation assessments from our deep equity research team here. We focus on not only the prospects, but also the risk characteristics, tapping into our accounting analysts. And then we marry that holdings level analytics with a look at cost. So we believe higher expense ratio products, or those that don't trade that often and thus have wider bid-ask spreads, are more expensive, and we favor cheaper products, and we'll come to that in an upcoming slide. As we move here, let me just go into value and give you a comparison of two different products that saw strong demand in the fourth quarter of 2018. iShares Russell 1000 Value, IWD, Vanguard Value, VTV. These are two different products. They track two different indices. Not surprisingly, the exposure is different. The major difference between these that we come across from a sector standpoint is from technology. And that's the result of Microsoft being considered a value stock for VTV, but is considered not a value stock and according to the Russell criteria, and thus is not an IWD. Microsoft is considered a growth stock from the Russell franchise. So you'll notice a significant difference in the sector exposures at technology and also in energy. Not only are the fees a little bit different, 15 basis points, but the exposure is really what we think is driving a 300 basis point difference in the track record in 2018. If you were in VTV, you would have lost a lot less money, and you might be happier with your portfolio than you would have been in IWD. That doesn't mean IWD is an inferior product. It just means it's a different product. Now let's move on to the next slide here. I'm going to focus on fixed income ETFs with a little bit of a longer-term lens, pun unintended, looking at duration characteristics that were in favor in 2018 versus 2017. As you know, the Fed raised interest rates multiple times. There's indications they are likely to continue to do so in 2019, and as a result, short-term and ultra-short-term oriented ETFs were very popular in 2018. You can see the orange bar significantly exceeding on the ultra-short, less than 1 year of duration, even more so whereas there was less demand for intermediate term and long-term bond products. Interestingly, we've seen a reversal of that to start 2019. Intermediate term products like IEF and ITE. IEF is from iShares, ITE is a State Street product, and longer term products, SPTL, are among the most popular ETFs in the first week plus of 2019. So again, nothing is static with ETFs nor ETF demand. Now on the next slide here, I want to just talk about a couple of the ETFs on the ultra short side of things, specifically on actively managed ETFs. I'm focusing on these in part because the total inflow or the inflows for these respective products, $8 billion combined, but these were big drivers to the fact that actively managed fixed income ETFs had $21 billion of net inflows in 2018. That's equal to the net inflows active fixed income ETFs had in 2015, 2016, and 2017 combined. So really strong interest in these products. Again, there are differences when you look inside. The duration is identical. The yield is slightly different. The yield is a little bit higher for near the iShares product than it is for JPST, but you are taking on different credit exposure risk. So we highlight the triple B exposure in particular. 32% of near is in triple B rated bonds versus the 18% in JPST. And I'm sure you've heard about the concerns that some people have about credit downgrades. This is intended to be investment grade strategies. Bond ETFs react to what's going on. These are actively managed, so we could see them hold on, but you want to be mindful of the credit risk exposure that you're taking within a portfolio. Now, on this upcoming slide here, before I wrap things up, I want to offer a prediction. We at CFRA believe there will be at least one, if not multiple, zero-fee ETFs. Now, Fidelity launched the first industry ETFs that were zero fee for mutual funds in 2018. Right now, there are 16 ETFs that charge 3 or 4 basis points in fees. There really isn't that big a difference between offering something for free and 3 basis points in the grand scheme of things. But particularly what's happening in the market environment where iShares and Vanguard are grabbing even more of the overall pie. Now, we mentioned the pie is expanding, but those top two firms now have 65% of the total assets. That's up over 300 basis points in the last couple of years. But what's even more notable is that in December, iShares and Vanguard gathered 95% of the net inflows, the $50 billion that flowed into ETFs. Just 5% went into firms not named iShares and Vanguard. That's SSGA and Invesco losing ground. That's even some smaller firms that had been gaining ground, Schwab and JPMorgan, that have been benefiting from the low-cost trend. I'll use, for example, State Street has a product, SPTM, that just costs 3 basis points. Seems quite reasonable that you might want to forego that extra revenue from the fee in order to help drive inflows and use your deep pockets to be able to grow brand awareness, in our opinion. On the next slide here, just to show you the way that we do some of our research, I'm sure you're all familiar with the stock research that's on MarketScope Advisor. On the left-hand side here is a sample of our ETF research report, color-coded to show you what's contributing favorably, that's green, unfavorably, that's red, yellow is neutral. On the right-hand side is an example of our thematic research that appears on MarketScope Advisor. If you liked what you heard from Lindsay, if you're interested in what we're talking about from an ETF perspective, this is the way that Lindsay and I publish our research through the thematic research portal on MarketScope Advisor. And if you don't currently have access to MSA, we'd encourage you to sign up. You can do so, I think, in the chat box here or on our website overall. And with that, Sam, let me turn it back to you to see if we have any questions from the audience.
Great. Well, thank you, Todd. Before we get off of the topic of ETFs, let me ask you, after a strong 2018, do you expect to see continued demand for bond ETFs in 2019?
Well, I do. I mean, we've seen it to kick off the year, even though rate sensitivity has shifted. We've seen, as mentioned, the intermediate and longer-term products do very well in gathering assets. We've seen demand return for investment-grade corporates. LQD has seen net inflows. We've seen demand for emerging market debt, EMB. So we've seen a shift in the sentiment within the fixed income space. But equally as important, while the Barclays Aggregate Bond Index was flat in 2018, the average core and core plus bond mutual funds lost money. Now, not much, but they lost money. And I think as more and more investors and advisors see the statements that their bond fund that was supposed to be safe lost money in 2018, they're going to look for a cheaper alternative, and there are many ETFs that do that.
Okay, good. Lindsay, just sort of as a reminder of what you had told us before, tell us again what sectors are expected to drive earnings growth in 2019. What kind of comparisons are you expecting in the year ahead versus the year just completed?
Well, you're going to see in 2019, you're going to see the largest growth come out of the industrials at 10%, materials financials at 9.2%, and then healthcare will also do very well at over 7% growth, and those are above the 6% expected, like I've talked about for 2019. So you have some of the cyclical sectors still expected to lead in 2019, which is what we're seeing in 2018, and we've seen throughout the quarter on a quarterly basis as well. So it's very similar to this year.
Okay, good. Now, we've been getting a lot of questions about two things in particular, the government shutdown and tariffs. Questions that have been asked of me frequently have been, what impact do I foresee with the current government shutdown having on the market? And looking back historically, what I find is that government shutdowns tend to be more of a headline event than a bottom line event. In the past 40 years, we've had more than 20 government shutdowns. The average duration has been about 10 days. The shortest was 4 days. The longest in the mid-1990s was 34 days. What's interesting, though, is that from the start to the end of the shutdown, the average price change was only minus 0.1%. So basically a non-event. The worst performance was a decline of about 4.5%. And interestingly enough, if you look at the S&P 500's performance from the close of business on December 21st, because the government shut down 12:01 on that next day, we're actually up 6.5%. So the government shutdown really hasn't done anything to the stock market itself. I think that the real concern in the stock market had to do with tariffs and had to do with whether we would be slipping into a new economic recession and preceded by a bear market. Well, we got awful close, as I showed before, down 19.8%. Obviously, nobody really knows for sure exactly what's going to happen. I think most people on Wall Street believe that this tariff tiff or skirmish will not turn into a full-blown tariff war as seen in the early 1930s. We also had some pretty encouraging news today where the 2-day conversation is going to be extended into 3 days, and the belief is that something will be announced before the end of March, which is basically the deadline. So tariffs are included in ETF predictions because these EPS, the earnings predictions, because obviously they come from analysts, and analysts can't help but be affected by their belief as to what's going to happen in terms of tariffs and what the guidance that they are getting from management as we move into this fourth quarter reporting period and as we move into all of 2019. So with that said, Lindsay, do you think that because now we're looking for about a 12.7% growth for the S&P 500 in Q4, it was as high as 15% on September 30th. Do you think management has set the bar low enough that we can exceed it once again?
Yes, I think we will exceed it once again, and I don't think we'll break with the course of beating by an average of 400 to 450 basis points at the end of the day. I think we will definitely get that. But the question really is what happens with 2019 expectations? And we expect they're going to come down and probably be cut to a sharper degree than may be priced into the market.
Right. Well, that sort of leads to another question that was just asked. Do we see another correction in 2019? I mean, by my perspective, probably not, because we've had the PE ratio sliced so dramatically that in a sense we've already reset the dials possibly for the next year. Maybe 2019 will be similar to 1999 in that in 1998 the market was off 19.4% as a result of the long-term capital management problem, the Fed stepping in, et cetera. So maybe we sort of sidestep a recession in 2019, but then I would look out for 2020. That said, I think we still have to be saying, this bull market is long in the tooth. This economic expansion is more than twice as long as the average expansion since 1900. So you don't want to be gravitating toward growth and low quality. You really want to be focusing, Todd, as you had said earlier, on quality. But could you also take that one step further? You were talking about, if we can get paid along the way. What about ETF dividends? You mentioned that they're growing in popularity. Can you give us a couple of examples that investors might want to examine?
Yeah, so dividend ETFs were very popular in the fourth quarter. I'll give two different examples. One from iShares, the ticker is DVY. The second one is from Vanguard, VIG. DVY is constructed based on dividend yield characteristics, and not surprisingly, the utility sector is about a third of the overall portfolio. This product from iShares, DVY, saw $1.2 billion of net inflows in the fourth quarter. VIG, Vanguard Dividend Appreciation Index ETF, there's also a mutual fund version of this, is focused on dividend growth, companies that have raised their dividends for 10 or more years. The industrial sector is the largest sector here, 27% of the portfolio. So you can see a more growth-oriented, economically sensitive slant to this. And this product, VIG, gathered more than $2 billion of net inflows in the fourth quarter. So growth on or risk on and risk off from a dividend perspective, both were popular in the fourth quarter.
All right, good. Well, let's just check and see if there are any more questions coming from the audience. It is now the top of the hour, and for those who want to stick with us, please do so. We'll answer a couple more questions and then wrap up and let you know where you can get the replay and the slides for from this presentation. So a question directed at me, which of the defensive sectors and how have they performed during prior bear markets? Well, I remember investors said to me that they felt that diversification failed us in 2008 for two reasons. One, they said that they were diversified. They were in large, mid, small U.S., developed international, emerging markets, REITs, and commodities. So they were diversified, right? Well, not really. Quantity is not the same as correlation, and that traditionally it's such safe havens as gold and treasuries that tend to do well when the market does poorly. In 2008, gold was higher, as was treasuries, up more than 20%. So a 60-40 portfolio, 60% S&P 500, 40% long-term treasuries actually did better in 2008 than they did in 1973 or in bear markets during the Great Depression. Second, in terms of sector performances, people said, well, wait a minute, I was invested in healthcare, staples, utilities, and they too went down. Well, history says they normally go down. They're called defensive not because they go up, but rather because they tend to lose less because the demand for the products and services remains fairly static. If you want to remember which sectors tend to do the best, remember the old adage that if the going gets tough, the tough go eating, smoking, and drinking, and if they overdo it, they have to go to the doctor. So with that, let me see the next question that's being asked at banks. Net interest margin has increased despite the flat yield curve. Why?
I'll take that. So I think what you have to think about with net interest margins is the yield curve just, Sam's chart showed it perfectly, was sharply declined to very flat throughout the course of this year. But going in, at the end of 2016, the Fed raised rates. In 2017, they raised them 2 more times, and then this year 4 times. So as rates went up, the curve was still, steeper than it is now. So that helped net interest margins along the way. But as we progressed through this year, you really saw that flattening impact the banks, especially as they had to increase their deposit rates to offset some of the upside they were getting on their loans.
Okay, good. Well, then I think I'll take this opportunity to wrap up and say that on behalf of the team at CFRA, we would like to thank you for joining us today. Within the next day, you will receive a note from us with a link to the replay and slides from today's session. We hope that you'll join us again for our next webinar, The Payments Revolution, Winners and Losers as the World Goes Digital, where CFRA's equity analysts will discuss payment companies, the winners and losers, and the outlook ahead as the world goes digital. In the meantime, please check out CFRA's Market Scope Advisor for our latest research. At any time, should you have any questions, please don't hesitate to contact us at cservices@cfraresearch.com. That's C, the letter C, the word services @cfraresearch.com. Thank you very much.